In investing, there are very few things we actually control, but fees and taxes are two of them. And in a low-return world, they're very important things to worry about. I'm Jack Otter, editor of Barron's.com. I'm here with Peter Rohr, I'm managing director at Merrill Lynch, and you focus laser-like on these issues. So let's give some advice to viewers, starting with, well, why don't you explain why it's so important, especially now, to be focused on fees, taxes, etc.?
Well, Jack, that's a great question. But again, with interest rates being so low, both here and again globally, in some cases negative, a low return world is something that we're all dealing with. So the ability to focus on taxes and fees is an ability to put more money back in the investors' pockets.
And how much are we talking about?
Well, in essence, if you look at the average cost of a mutual fund, it can range from 1.40, 140 basis points, but the difference down to an ETF or a passive index fund could be as low as 0.10 or 9 basis points. So that's a substantial savings of almost 90%.
And then on taxes, you can go even further.
Taxes actually even adds a little bit more, because when you look at what's going on with actively managed funds, where they're paying out capital gains, they're paying out distributions, they're paying out dividends, in many cases, those mutual funds by law, once a year, have to pay out those distributions regardless of your performance, negative or positive. So with an ETF or a passive index fund, the ability for you to control that in an ETF form is those distributions are not being forced to be paid out to you. So you have a choice. The capital gain only comes when you sell an ETF. It's not being forced on you annually.
So maybe 1.5 percentage points every year for a decade, that can compound to quite a number.
The compounding is impressive over time. You're talking 10 percentage points annualized. Think about that, what that might mean to $100,000 to $10,000 to $10 million.
So let's start with taxes. What do you do to minimize those taxes?
So the first thing you want to do is every mutual fund by prospectus, again their version of the law, has to pay out a distribution. And they're going to tell you that sometime between the first week of October and the last week of November. It behooves you as a shareholder to take a look at that, because sometimes you could be surprised. So if it's a $10 value of your mutual fund, there could be taxes that could be paid out to you in the form of $1 or 50 cents. That's impactful. That's 10% of your holdings. Take a look at that, educate yourself. How we try to do that then is move away from actively managed mutual funds, actively managed stock pickers, and move towards a passive environment of ETFs or index funds where you don't have that prospectus item and you can just continue to hold your investments for time at infinitum.
And importantly, the taxes don't necessarily reflect the recent performance of the fund. So you could have a fund that's down, but if they sold a long time position that had been a huge gainer, you can still get hit with the tax.
That is a fantastic point. In 2011, as you know, was a negative year for the market. 87% of all mutual funds that were in large cap had a negative return. 100% of them paid out a capital gain that year.
So let's move on to fees. How do you keep those down as low as possible?
Okay, so you have to be laser-like on this. So the most important thing is, if you're going to be in the large cap world, again, the stocks and companies that we know, the Apples, the Googles, the Fords, the IBMs, you might as well be indexing that. An index fund in Vanguard or at Fidelity, wherever you choose to go, or even BlackRock, what will happen is that fee is so de minimis, so small, that's the easiest way. Areas like mid-cap and small-cap international, you can probably use an ETF and index fund, but if you want to look for management, if you want to look for expertise and outperformance, those are the places to look for. Small cap international, there's probably not an index made that probably outproduces a manager.
And the difference in the fee between the index fund and the active management is smaller in those areas that you just identified, right?
Yes, it's smaller. So but again, you can, if you look at a very big fund, I won't name it, but there's ones that run about 1.1%. If you look at Vanguard's index fund at 0.09, again, that's 1% to you, even in the big cap world. So where it's really just easy shooting, low-hanging fruit, you want to be indexing or using an ETF in that space where you can basically save money. And 1% a year, every year, in this environment, adds up in your pocket.
So one more point. With all you're saying, it's implying that it's just not worth it in many cases to pay for active management. You're essentially making a case for passive investing. Why is that?
So what has occurred is, if you look at the recent report that came out, and it comes out all the time, which is SPIVA, which is a report, only 13% of active managers just this year have either equaled or outperformed the S&P. So if you and I knew that there was an 87% chance of lightning striking this interview right now, we'd be moving this interview.
Yeah,
well,
we would.
That's what you have, is that type. And over years, the SPIVA report, 91% of index funds outperformed all active managers. Again, 91%. You don't have, that's pretty impressive.
That's a good bet.
That's a good bet. So be there if you can. Save money, save taxes.
Thanks very much, Peter.